In this video, we are going to talk about investing in the stock market for beginners. So before starting this video, please like this video and subscribe to our channel for future. Let's dive into the topic. News shows, Hollywood films, and TV all assume that you know what the stock market is and how it works. Everyone knows that you can make a lot of money in the stock market if you know what you're doing, but beginners don't often understand how the market works and exactly why stocks go up and down. Here's what you need to know about the stock market before you start investing. What is the stock market? Stocks, which are also called equities, are securities that give shareholders an ownership interest in a public company. It's a real stake in the business, and if you own all the shares of the business, you control how the business operates. The stock market refers to the collection of stocks that can be bought and sold by the general public on a variety of different exchanges. Where does stock come from? Public companies issue stock so that they can fund their businesses. Investors who think the business will prosper in the future buy those stock issues. The shareholders get any dividends plus any appreciation in the price of the shares. They can also watch their investment shrink or disappear entirely if the company runs out of money. The stock market is really a kind of aftermarket where people who own shares in the company can sell them to investors who want to buy them. This trading takes place on a stock exchange, such as the New York Stock Exchange or the Nasdaq. In past years, traders used to go to a physical location, the exchange's floor, to trade, but now virtually all trading takes place electronically. Of course, you'll need a brokerage account before you start investing in stocks. As you're getting started, here are 9 more guidelines for investing in the stock market. Let's start. Number 1. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. You'll have to study the company and anticipate what's coming next, a tough job in good times. Number 2. Avoid individual stocks if you're a beginner. Everyone has heard someone talk about a big stock win or a great stock pick. Remember, to make money consistently in individual stocks, you need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. An alternative to individual stocks is an index fund, which can be either a mutual fund or an exchange-traded fund. These funds hold dozens or even hundreds of stocks, and each share you purchase of a fund owns all the companies included in the index. Unlike stock, mutual funds and ETFs may have annual fees, though some funds are free. Number 3. Create a diversified portfolio. One of the key advantages of an index fund is that you immediately have a range of stocks in the fund. For example, if you own a broadly diversified fund based on the S&P 500, you'll own stocks in hundreds of companies across many different industries. But you could also buy a narrowly diversified fund focused on 1 or 2 industries. Diversification is important because it reduces the risk of any one stock in the portfolio hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really to have all your eggs in one basket. The easiest way to create a broad portfolio is by buying an ETF or a mutual fund. The products have diversification built into them, and you don't have to do any analysis of the companies held in the index fund. Number 4. Be prepared for a downturn. The hardest issue for most investors is stomaching a loss in their investments. And because the stock market can fluctuate, you will have losses occur from time to time. You'll have to steel yourself to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk, try how you might. That's why it's important to prepare yourself for downturns. Number 5. Try a stock market simulator before investing real money. One way to enter the world of investing without taking risk is to use a stock simulator. Using an online trading account with virtual dollars won't put your real money at risk. You'll also be able to determine how you would react if this really were your money that you gained or lost. Asking yourself why you're investing can help determine if investing in stocks is for you. Number 6. Stay committed to your long-term portfolio. Investing should be a long-term activity. You should divorce yourself from the daily news cycle. By skipping the daily financial news, you'll be able to develop patience, which you'll need if you want to stay in the investing game for the long term. It's also useful to look at your portfolio infrequently so that you don't become too unnerved or too elated. These are great tips for beginners who have yet to manage their emotions when investing. Number 7. Start now. Choosing the perfect opportunity to jump in and invest in the stock market typically doesn't work well. Nobody knows with 100% certainty the best time to get in, and investing is meant to be a long-term activity. There is no perfect time to start. Number 8. Avoid short-term trading. Understanding whether you're investing for the long-term future or the short term can also help determine your strategy and whether you should be investing at all. Sometimes short-term investors can have unrealistic expectations about growing their money, and research shows that most short-term investors, such as day traders, lose money. You're competing against high-powered investors and well-programmed computers that may better understand the market. New investors need to be aware that buying and selling stocks frequently can get expensive. It can create taxes and other fees, even if a broker's headline trading commission is zero. If you're investing for the short term, you risk not having your money when you need it. Number 9. Keep investing over time. It can be easy to dump your money into the market and think you're done, but those who build real wealth do so over time by adding money to their investments. That means having a strong saving discipline, holding back some of your paycheck so that you can put it to work in the stock market. You'll be able to put more money to work and grow your wealth even faster. You may already be doing this if you have a 401k retirement account, which takes money from your bi-weekly pay and puts it into the investments you've selected. Even if you don't have a 401k, many brokerage accounts allow you to set up automatic transfers to your account. Then you may be able to set up automatic investments at a broker or one of the best robo-advisors. You can automate the process of investing, helping to keep your emotions out of the process. By following these 9 steps, anyone can invest in the stock market and start their investing journey now. And if you find my video helpful or you are interested to watch more content like this, so make sure you can subscribe to my channel and hit the bell icon as well. We will meet again with another interesting topic. Till then, stay safe and stay happy. Safe and stay